Welcome to Frost and Sullivan's Growth Podcast. In each episode, we take a deeper look at transformative shifts shaping global ecosystems, from industry megatrends and technology innovation to evolving customer expectations. Today, we're exploring global risk and resilience, where disruption is redirecting investment through 2027, unpacking where the next wave of opportunity is unfolding and what it means for future-ready businesses. Global disruption is changing growth economics. Geopolitical conflict, trade fragmentation, energy volatility, and technology restrictions are becoming more interconnected. A disruption in one part of the global system can quickly affect freight costs, production, sourcing, technology access, and investment conditions elsewhere. Critical trade and energy corridors show the scale of this exposure. The Strait of Hormuz carries roughly 20% of global oil flows. Disruption in 2026 reduced vessel traffic by more than 70% and pushed Brent crude above $100 in the first quarter. Concentration risks are also visible in technology and strategic inputs. Taiwan accounts for 92% of advanced logic capacity, while disruption in critical minerals has already affected manufacturing activity. For businesses, this means risk can no longer be assessed in isolation. Energy shocks affect production economics, trade restrictions influence market access, and supply concentration can quickly weaken continuity across connected industries. Global risk mapping, therefore, has a larger strategic role. It helps businesses understand where geopolitical, trade, infrastructure, and technology risks intersect, and where those exposures could alter long-term growth conditions. Resilience is redirecting investment and supplier demand. Industry responses are already changing. Supply chain diversification and China Plus One strategies are redistributing manufacturing capacity toward India, Southeast Asia, and selected nearshore locations. This is creating demand not only for production capacity, but also for industrial infrastructure, logistics, port development, compliance, and supply chain services. Energy security is generating another layer of investment. Storage, strategic reserves, alternative fuels, import infrastructure, and flexible energy systems are gaining commercial relevance as businesses and economies reduce exposure to concentrated supply. Digital infrastructure is also moving closer to the resilience agenda. More than 100 cyber incidents were reported within the first 72 hours of the 2026 U.S.-Israel-Iran conflict, while more than 99% of global data traffic moves through undersea fiber optic cables. That dependence increases the value of secure connectivity, redundancy, failover capabilities, and infrastructure protection. The commercial implication is significant. Strong demand alone no longer makes a geography attractive. Infrastructure readiness, policy exposure, talent availability, supply resilience, and execution capability now influence where investment can scale. Supplier relevance is changing with it. Regional presence, continuity capability, compliance readiness, and integration into resilient local ecosystems are carrying greater weight. 3 growth opportunities emerging from resilience investment. 3 opportunities stand out through 2027. First is energy security through supply diversification. Valued at more than $1 billion over 5 years, this opportunity spans liquefied natural gas infrastructure, storage, strategic reserves, alternative fuels, and cross-border energy systems. It expands participation across engineering, logistics, storage, and flexible infrastructure. Second is trade diversification and regionalized manufacturing. U.S. imports from China fell 29% in 2025 as trade and production shifted across regional hubs. The resulting opportunity spans industrial infrastructure, logistics modernization, port capacity, and trade enablement services. Third is cybersecurity and digital infrastructure protection. Valued at $100 million to $500 million over 5 years, this opportunity covers secure connectivity, redundancy, digital infrastructure protection, and continuity capabilities. Together, these areas show how resilience is moving beyond defensive risk management. Through 2027, commercial advantage will depend less on avoiding disruption altogether and more on maintaining investment, production, and connectivity when disruption occurs. That changes the role of resilience. It now influences where capital can scale, which suppliers remain relevant, and where long-term growth can be sustained. Resilience is no longer only protecting growth. It is becoming part of how growth is created. Thanks for joining us on Frost and Sullivan's Growth Podcast. For access to our research, competitive benchmarking, and best practice frameworks, head over to frost.com or email transformation.growth@frost.com. We'll be back soon with more to help you stay clear-headed and growth ready.